Good morning and welcome everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It is Tuesday, April 21st, 2020, and we are pre-recording this Trading Places Live. But currently futures are pointing to a weak open with Dow Jones futures lower by close to 500 points. We finished weak yesterday. Looks like we're going to get off to a weak start today, and we'll have to see where we go from there. Let's take a look at what we're going to go over today. I'm going to start off with that daily market recap, as I always do. Then we'll get into some talking technically. Want to specifically look at the S&P 500. I mean, it looks to me like the market may give it give another shot to the downside. And if it does, I want to take a look at a few support levels on the S&P 500 that we should be watching for, potentially for a reversal. If that occurs, the short-term selling could be over and we move higher again. We'll see. Relative strength, I want to get in and take a look at some of those key industry groups that you should be aware of, both on the strong side and the weak side. We'll take a look at earnings spotlight. There are several companies now beginning to report, some big names, and I think you're going to want to hear a little bit about not only what they reported, but how the market is reacting to that news. We'll get into the upgrades and downgrades after that. Got a few to share there, and then we'll wrap up with three you must see. And I'm telling you, there are three. I'm not normally someone who likes to short in a what I think is a secular bull market, which I believe we're still in. We're in a cyclical bear within what I believe is a long-term secular bull. So I do expect we're going to pull out of this and go higher in time, but I'm not discounting the fact that we have a really tough several weeks probably to go through here, maybe even several months. But I think that there are some areas, if I was going to short, that I would definitely favor. And in that final segment, I want to show you three charts that I'll give you reasons too, but I think that there are three charts that I would be very interested in, given this recent move to the upside. If we do in fact roll over, I think there are three stocks in particular that could get hurt as we move up lower. But again, I'll talk about that to wrap up the show. But first, let's go ahead and jump into the daily market recap. And you can see yesterday was not a great day. It started off like many days did back in the first half of March, where we gapped down, and then the market came rallying back. After a pretty big gap down, we did see the NASDAQ actually break into positive territory. But the end of the day, we saw selling, and we closed not on the lows, but close to the lows. And that usually portends further weakness ahead. And we are seeing the futures, as I mentioned earlier, down quite a bit today. So this is, again, I'm going to get in and show you some of these support levels on the S&P to watch. But based on the way the market's set up right now, it certainly looks like it wants to go lower in the near term. Dow Jones yesterday down 592 points, the S&P 500 down 51, the NASDAQ down 89. A lot of outperformance on the NASDAQ, even though it was down 1%. You can see the Dow was down 2.4%, S&P 1.8%, and as we get into the mid cap and small cap, which have been underperforming throughout much of the past 2 months, both of those groups were down at or close to 2%. As far as the individual sectors go, to the downside, utilities, real estate, energy, 3.78%, 3.71%, 3.12% respectively, all of them below key moving average, definitely below the 50-day. And in the case of energy, it moved back down below the 20-day moving average, or close to it. Actually went down, I think, intraday below, and then managed to close just above it. But moving below the moving averages, with both of those moving averages rolling over and going lower, would not be a good technical look. On the positive side, though, these were negative. They finished in negative territory, but on a relative basis, they were positive. The best sector yesterday was healthcare. This has been a continuing theme since February 19th top. Healthcare, even in the really poor move to the downside back in the first half of March, outperformed, and it's been continuing to be an outperformer. I mean, just take a look at it relative to its moving averages. That 20-day moving average is actually getting ready to cross. We're about to get a very bullish cross of the 20-day over the 50-day. Which would just confirm what we've been seeing in the price action. Also, if you look back, we had a double top on the XLV close to that 105, 104, 105 level, and we were trading over 100 yesterday. We're not far from moving back to another high on the XLV, and that's pretty impressive when you consider where our major indices are. relative to their highs, their recent highs. So I think the leadership there clearly showing. Communication services also strong yesterday. It's been a little bit better than the average stock. You can see we're up near the 50-day moving average, trying to get through that. This is also where we had that first move down to about the 48 and change, 49 area. We bounced up to 53, and then you can see the XLC breaking down. Well, this move back up to the 50-day also is testing that area of breakdown in early March. So some key levels there. All right, let's move on to the 10-year Treasury yield. I do want to say there's one economic report out later today that I'd be watching. It's March existing home sales. February wasn't really impacted with existing home sales. We saw that number come in at 5.77 million units. The expectation is for 5.40 million units, so a slight decrease from what we saw in February. Things really started to pick up to the downside economically in the early to mid part of March. So existing home sales, this is going to be the first report that's going to have an impact. I would be surprised if this number doesn't come in a little lower than expectations, maybe closer to that 5 million number would be my guess. And then I expect April to be much lower on existing home sales. It's kind of hard to go out and buy a house if you can't go see it, and kind of touch it and walk through it. Virtual home sales, I don't know, I wouldn't be a big fan. But anyway, then later in the week, of course, we'll have some other reports coming out. Initial jobless claims will be out on Thursday. March new home sales come out Thursday as well. And then another report to watch closely on Friday is April consumer sentiment. The March number came in at 71, which was a historic drop from February when we were at 89.1. So we lost 18.1 down to 71. April is the estimate 68.1. I think that number also could come in actually a lot lower than that. We'll see how that number comes in. But that's going to be on Friday along with March durable goods, which ought to be really interesting because that's a volatile report to begin with. Okay, 10-year Treasury yield. You can see, let me go ahead and give you an update here. Actually, I don't think this is going to show me anything. I can tell you that the 10-year Treasury yield's down another 4 or 5 basis points, about 5 basis points last time I looked, 0.58%. And I've been saying watch this 0.57% level because if we lose it on a closing basis, that to me looks like another breakdown in the yield. And a breakdown in the yield means a breakout in the Treasury prices themselves. And if Treasury prices are breaking out, that's telling you the market's more fearful, looking more for safety. And so as a result, I would certainly expect to see the volatility index pick up. Yesterday, it was one of the biggest increases in the volatility index that we have seen, certainly for the last month since middle part of March on this move down. We haven't really seen too many of these hollow candles where the VIX rises throughout the day and closes on the high. We saw that yesterday. So I think the fact that the volatility is picking back up, maybe the fear levels are increasing, the yield potentially breaking down. That's why I said I think this could be the start of another push to the downside. And where we go, if it is, if we do start a trend back down, how far we go is going to be really important in terms of just a bigger picture. Are we going to be in this for, a few more weeks? And when I say in this, I mean the decline that we saw from February. Is this just a few more weeks and we're going to move back up? Everybody's, the economy's going to reopen or start to reopen and the market's going to feel better. Remember, the stock market's not going to go to an all-time high when everybody's back to work. Stock market's going to go to an all-time high in anticipation of everybody going back to work. That's the thing you have to understand about the market. So don't think the stock market can't go to an all-time high while we're still trying to recover from the pandemic. A lot of the economic reports, the destruction that was done in the economy, the market started going down before that, before we started seeing those economic reports. And so again, the market's going to look ahead. And so figuring out what the market's doing and interpreting what the market's doing as it's doing, it's really important because those Wall Street, our stock market is probably the best leading economic indicator we have. So that will be telling us what's going on. Now, the thing that's going to work against the market in the near term is fear. And so as that volatility index picks up, I think if we get back up into the 50s, that's going to be problematic. And so, first of all, anytime you're above 20 on the VIX, I'm not excited about the market. So we're already volatile. We already have a certain amount of fear. And when you have a certain amount of fear and the market starts selling off, fear can just continue to steamroll. And it's almost like that snowball effect coming down a mountain. So we'll see how it, how the VIX opens today and how it trades. But a close back up over 50, I would really start to batten down the hatches a little bit again. And let's see what this market does on this move to the downside. So let's take a look at the S&P 500. Where are those levels that we should be watching? Well, first thing I want to do is pull up and annotate Fibonacci. Again, just show you how you can do this quickly on StockCharts. Very easy. And right about there is what we're looking at. So in 2008, 1987, we never got back through this Fibonacci 50% retracement level. So this one's already a little different in that regard, in that we did get through. In fact, the NASDAQ got through the 61.8% level. But let's just focus on the S&P here. We went up, we hit the 50-day moving average, got just above it. Now it looks like we're starting to roll over. So let's put our bearish hat on and say, okay, we are going to roll over. Where could we go to? And I would say this, first off, when I see an S&P 500 that has cleared that center line right here, this is telling you that your 12-day moving average has moved above your 26-day moving average, exponential moving average. Normally in a downtrend, in a bear market, you don't see this happen. You certainly don't see it happen on the very first move back to the upside. So this is a little bit unusual. So if this is truly going to be a V bottom, and I don't think it's going to be, I don't think we're going to go straight back up. I would expect maybe some consolidation at a minimum after this rally. But if we are going to sideways consolidate and eventually break up and kind of give a V bottom instead of going back down and testing this bottom down here, then I think the first level that you've got to consider as a possible support area would be that rising 20-day moving average. So that right there is going to be important. Currently, that's at 27.20. We closed yesterday at 28.20. That's 100 points, which is roughly about 3.5% from where we are or where we were at the close yesterday. Well, we're down, 1.5%, maybe 2% this morning, something like that in the pre-market. In fact, I'm going to go ahead and get a quick update on that. Yeah, the Dow right now is down 2%. S&P is down 1.75%. So if we need a 3% drop, we're down 1.75% at the open. That doesn't give us a whole lot of room before we test this first key level. And that is going to be an important level. All right, so let's say we go down the 20-day and that doesn't hold. What's the next thing to watch? I'm going to get rid of the Fibonacci here for just a second. And I would be watching if I've been breaking down this rally into stages. So we came down off the March 23rd low. That first initial 3-day rally took us up to about 26.30, 26.40, I don't know, something like that. And then we pulled back. So we set a resistance level, pulled back, and then we broke out above that resistance level. Well, when you break resistance, TA 101, broken resistance becomes support. So when we look at this and we put this resistance line in right here, see, that was the resistance. We went down, we came back up, broke above it. That becomes a support level. So I could then also put in another key area of support, which would be this price support, which is roughly that 26.30 area. All right, let's say that doesn't hold. I mean, that would be another 100 points below the 20-day moving average. Then the third one, and this one would be much more significant, I believe, because it marked a key area of where the sellers, initial sellers, were met with more buyers, came back up. So I think right here, this support area right here at about 24.50, 24.60, this is the final level that I would watch. If we can't hold those three, then I think the odds of the retest certainly are much greater. That's kind of a duh moment. Right now we're up at 2,800. If we can't hold 24.50, clearly 2,200 is going to come back into play. But the reason I'm putting these three levels in, I'm going to be looking to see if the S&P 500 moves below these key levels one day and then reverses and comes back up above and closes near the high of the day, because that would be an indication that you had intraday selling, a breakdown, and a rally. And if you get a rally at the end of a day after a breakdown, normally that's a pretty good sign market makers are accumulating. And though that's what I really want to pay attention to is when do market makers go long on this pullback? And, you know, don't know until we see the action. So those are the key areas that I would be watching. All right, I want to move into relative strength. So what I do is I like to take a look at the performance of all the various industry groups relative to the S&P 500. And when I do that, you can see the top performers at the top of this list. And this is an intraday. I could change this. I could go back and look at it. Okay, what's been leading over the last week? What's been leading over the last month? What's been leading over the last 3 months? And you can find all the key areas if you're looking for, you know, really solid strength. Now, mining, gold, and mining stocks, they've been the best over the last 3 months. You have to understand also that these two groups perform their absolute best when the market is fearful. That's one of the go-tos. That's one of the safety nets that investors look for, professionals look for, hedges. So anytime the market is fearful, you're going to see these two groups do well. They may not be at the top, but normally they're going to do pretty well on a relative basis. And this time they just so happen to be leading. Do I like gold and mining shares going forward? I don't. If you believe the stock market's going to continue going lower and it's going to go down and test those prior lows and maybe break below those prior lows, and we've got the Great Depression coming, then yes, those would be two areas that I would be heavily focused on. I don't believe that, though. I think, as I said earlier, I think we're in a secular bull market. These are two groups that lagged throughout, you know, from 2009 throughout 2020. The relative strength line of both of these groups relative to the S&P were going down almost constantly for 11 years. But they bounce when the market is fearful, and we're in a fearful period right now. So short term, yes, I'm not opposed to trading these groups when there's opportunities, but I don't believe in these two groups longer term because I do think the stock market goes higher. But you get beyond those two groups and you take a look at what's been leading over the last 3 months in this kind of an environment, I think you're coming up with some of the leaders. Broadline retail, biotechs, specialty retailers, toys, software, autos, mobile telecommunications, non-durable household products, pharmas, food retailers, medical equipment, specialty finance down here, water. These are the groups that have been leading for the last 3 months. And honestly, if you're going to be in on the long side, I would be focused on these groups, because what we have seen over the last 2 months is, for the most part, a lot of gap downs where we're seeing a lot of movement to the downside. Most of this decline that we've seen over the past couple months has been at the open. And then we're actually seeing the market diverge at the opening bell. Some groups continue to sell off after the opening bell, but other areas we're seeing a lot of rotation. And so I think what a lot of professionals have been doing is selling their losers that are going to continue to struggle going forward with this new economy that we're going to have, which is mostly a lot of it's online. And they're staying away from those groups and moving into the groups that are going to benefit. And there are a lot of stocks out there that are doing very well, or a lot of companies that are doing very well, and a lot of stocks are performing well. But I think you're going to find many of them in these leading groups. So I think relative strength plays a huge role. Now, if you look at one of these, and I'll pull it up just to show you here, you can look at, say, broadline retail. Look at this group relative to the S&P. This isn't saying that broadline retail has broken out, even though it has. This is the absolute chart down here on the bottom. So broadline retail has actually moved to a new high. Of course, this is the home of Amazon, and you know, if you've been following the market, Amazon's had a huge run. Broadline retail, though, on a relative basis, doing exceptionally well. But let's go to the next one on the list. How about biotechs? I've been screaming about biotechs. Look at biotechs. They are now up at a level they had not seen since 2018. And I believe yesterday's close was the breakout in the biotech group, going back many years. So multiple years of sideways consolidation. We finally made the breakout. I think biotechs, I said it yesterday, if I had to own one industry group, if you said, okay, Tom, give me one industry group you'll buy today and hold for 3 years, you can't sell it, biotechs would be my group. This is a group that soared early in the bull market, but for the last 4 years didn't participate. And now it's beginning to show that relative strength, and it's making the breakout. I think this is a group that could lead the market for the next 2, 3, 4 years. Wouldn't be surprised at all. All right, let's take a look at maybe one more group. And I'll tell you what I'm going to do here. Let's reverse this and just take a look down at the bottom. So over the last 3 months, what's not working? Well, you can see this consumer discretionary group. This is recreational services. Yeah, this is a pretty tough group. It has been a tough group, and it's likely to continue to be a tough group. But if you just look, these are all the industry groups relative to the S&P, and this tells you the different sectors that they're in. So XLY, XLE, XLRE, XLE, XLB, XLI. There's consumer staples, not too many of those down the bottom. Real estate, energy, financials, industrials. You're not seeing healthcare. You're not seeing technology. These are groups that actually are on the flip side. So we go the other way, and you'll see there's healthcare, technology, healthcare, right down the list, technology, and then you throw in some consumer staples, consumer discretionary, but you don't see real estate. You don't see energy. That's what's been happening in the market after the opening bell. Energy, real estate, utilities, those groups have been selling off. And after the opening bell, these other groups that have been leading, the healthcare, consumer discretionary, technology, those are the areas that have been leading after the opening bell. You got to recognize it. All right, let's move on. How about earnings? Let's go to earnings reports. And first up, I'm going to take a look at IBM. Let me just get you a quick update on the pre-market action here. Down 4.5% on IBM. They actually beat $1.84 versus $1.78. And I think this is going to be a common theme because remember, the first quarter, the economy was fine January and February. It was really March when things started to deteriorate. So I think that a lot of these companies didn't really start to feel the impact until the very end of the first quarter. So it's going to be next quarter where you're going to see a lot of really poor reports. And many of these companies are either going to lower guidance or they're not going to give guidance. And many of them won't give guidance. But let's take a look at IBM on the chart. So it's down about 4.5%, probably going to go back below that 20-day moving average. Accumulation distribution hasn't been bad on this stock. And this is my go-to signal that I've been looking at on a lot of stocks because with the market gapping down, some stocks recovering, the stocks recovering are showing accumulation distribution on the rise. The stocks where we've gapped down and continue moving lower are the ones that are showing poor accumulation distribution. Now, I like to use this signal in concert with relative strength. So it's not just accumulation distribution, but I also want relative strength. I look at IBM, and IBM's near a 52-week low relative to its peers. So the accumulation distribution makes me think the stock's being accumulated, but relative strength should confirm that. I mean, if this stock's being accumulated, it should be one of the best stocks in its industry, and it's not. So I think there's mixed signals on IBM. It is gapping down at the open. I personally don't like it. I think there's too many other stocks that look better than IBM, so I would pass. Now, another one that I did like going into its earnings report is CDNS, which is in the software space, which has been pretty strong. And you can see strong accumulation here. And you also can see CDNS, which was a poor performer on an absolute and relative basis in March, has actually come back and strengthened considerably in the last month, which I like. So if you look at the relative strength on CDNS, you will see the nice rally in the last 30 days relative to the software group. So I think this downtrend has ended. I think this is a stock that's trending higher versus its peers, versus the S&P. And we already know software is a strong group. So I would favor something like CDNS. They did beat 60 cents versus 54 cents. But, and I have not even looked at this. Let's see what futures are taking a little bit of a toll here. Down 2%. But this is the type of stock that I'd be more interested in on a gap down, because if you look at this stock really since probably late February, early March, there's a lot more hollow candles and movement off of intraday lows than there is or then there are filled candles where we see continuing selling. So in other words, short-term weakness, early morning weakness, a lot of time leads to more strength. Now, I've got 354 stocks on a strong AD chart list, strong accumulation distribution chart list. These are the companies that I'm really favoring trading on the long side. I can choose among any of them. So CDNS is gapping down, but it's still got room to the 20-day. So I would rather find stocks that have been showing this kind of strength, relative strength, accumulation distribution lines that are rising, but also on gap downs are testing key support levels. So I think CDNS has a little bit more room. I'd be a little more cautious there. Let's look at one other one. How about, let's look at FITB. This is a banking stock. They missed their earnings, 13 cents versus 23. You can see on a relative basis, the stock really got hurt in March, trying to come back over the last month. But the whole group has just been very weak with 10-year Treasury yields continuing to drop. And when I look at the accumulation distribution, down near a low recently. It bounced just the last couple of days, a couple hollow candles there. But overall, it's been pretty weak. So what is FITB doing in pre-market? Down 2.34%, 1629. So it's going to open below that 20-day moving average again. Yes, the last 2 days it's had hollow candles, but this thing's been going down. I don't know, with 10-year Treasury yield down 5 basis points today, I would not want to own a bank that just missed earnings. So I personally wouldn't be interested in FITB. If I did anything, it'd be on the short side. All right, I do want to mention also, coming up after the close today, Netflix, Texas Instruments, CMG, all of those. Actually, one other stock I'll show you real quick, and that is SYF. Now, I did a webinar for members yesterday, and SYF actually was one I said that I would not want to own. Look at the accumulation distribution. It is down near lows. It did miss its earnings. I wanted to see what this one did or what it's doing in pre-market. Down 2.5%. So it continues to move lower. All right, upgrades, downgrades, AAP. This is Advanced Auto. Stock was upgraded today along with KHC, Kraft Heinz, Las Vegas Sands, LVS, Southwest Airlines, LUV. Wouldn't trust that upgrade. Downgrades, we got stocks like CDLX. This is an internet stock that's been kind of interesting, trying to make a breakout here, but its accumulation distribution has been going down. It got downgraded today, along with Eli Lilly and ILMN. All right, let's go ahead and move on quickly to the three you must see. I'm going to pull these up very quickly. CNK, look at the AD line, horrible, right at resistance here. And it's in that recreational services area of the market that I showed was the weakest area. Oh, I think this one rolls back over. I don't like CNC or CNK at all. CC is my second pick. Watch to the downside. Horrible accumulation distribution. This one's in materials area. Came back, came down, tried to rally through 11.5, couldn't get there. I think this one's poised to roll over. And my last one to watch from a short perspective, Valero Energy, VLO. Huge move down, rallied back up. I just don't like this accumulation distribution part of energy. Be really careful. I think this one goes lower. That's it. Everybody have a great day. Be back on Thursday. Happy trading.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.